Alrighty, and just like that, we are back. Another month, another rent report, more data to discuss, and of course, David Isaacoff joining us for the data dive again. David, how we doing, man? We're getting close to the holidays. We just got a lot of snow. How we feeling, bud?
Best time of the year. Winter came early. I love it.
See a small tear run down your cheek as you say that.
I'm actually one of the few people that seems to enjoy the masochistic parts of living in Canada. The moment it snows, that's when I'm happiest.
Yeah. Give me the pain. Alrighty, so we're going to talk about our latest rent report that came out, and we've had a few new exciting updates for it. The first thing is an executive summary at the top of the report there that just gives the highlights a lot more quicker and easier for our viewers. If they don't have as much time to look through the whole report, at least we give you a little bit of a taste there. So let's kind of go through it. Rent declines again for the 13th consecutive month, but the decrease that we saw in October was actually the smallest in nearly a year. We'll chat about what that suggests. We're seeing purpose-built rentals remain fairly stable, only down by 0.5% year over year. Vancouver and Toronto have hit multi-year lows, and shared accommodations have fallen to a 28-month low. So a lot to chat about, but I think a good place to start is that slowing down of the softening of rents. What are your takeaways on this, David? Do you think it signals anything? Is it important to note? Is it seasonality? What do you make of it?
Yeah, very much. I think that this is a response to seasonality. When we look at the long-term trends on a year-over-year basis, or on an annualized basis, I should say, we see that as the year starts, typically there's a little spurt of activity that typically will then slow down in this following month, and then we'll see a gradual recovery in through the spring, and then obviously a substantial rebounding in the summer months, followed by softening and then decline. If we were in a conventional seasonal pattern, we would be well into that winter slowdown. And although we've been seeing unseasonable demand trends, we are still seeing that rental demand is slowing into the winter. And I think that when we look specifically at the trajectory of rental rates, we see that the same thing is really happening right now into the winter months. Now, annual comparisons, you have to really understand the fact that it's not necessarily just about the trajectory of where we are now, but it's about where we've been over the last year, right? Over the last year, there was a lot of movement, but if we look at the last December, that was really roughly when we were close to that bottom end, the peak, after which we saw the rents come rebound again into the summer, and then we saw the rents slowly decline once again. So really, it's just because we're kind of regaining or recovering to that same relative level, and that's why we're seeing that year-over-year rent comparisons are not showing as dramatic decreases anymore. Now, where we go from here is a different story. That being said, with record apartment completions really across the country, a lack of new condo construction, and a relatively, or I shouldn't say relatively, but very slow rental market in terms of actual demand prospects or renters on market, I don't expect to see any substantial rebounding in rental rates anytime within the next year. We're likely to continue with a soft market into 2026, certainly through the colder winter months, November, December, January as well. But I think that moving into the new year, we're likely to see a continuation of this softer market, and that's really because the two contributors of rents are slower, or I should say the demand for them is slower, and the supply is gradually increasing, which means that we're seeing an imbalance. And it's a good thing from the perspective of a return to a more balanced market. Obviously, we're not quite at a balance right now. There are other factors that are going to limit demand recovering as well. Obviously, we have reduced in migration, or fewer permanent or temporary residents coming into the country as well. So all of these factors are really coming in and bringing down relative rental demand. And obviously, the amount of construction we're bringing to market right now was primarily a response to that really high rate of migration we were seeing for the last few years. But now that that's slowing down, we're likely to see, again, a greater rebalancing, which for the long term, I think is actually a very positive thing. It suggests that rents are going to move in a more stable trajectory. We're not going to see these wild fluctuations up or down. At the end of the day, I think that we're all pretty much on the same page. We're looking for a return to sanity. we're looking for a way for the market to balance itself, so that there is a more greater, stability, greater balance between property owners and renters.
And that kind of reflects a little bit in the data as well, because purpose-built rentals were down by less than 1%, but we saw condo units down about 4.5%. We saw secondary market rentals down closer to 5%. So the data checks out there. And, we touched on it a little bit about the demand side of things, and I don't want to get too deep in the weeds there, but a lot of the interviews I've been doing are asking me, and I guess Rentals.ca on my behalf, your behalf, uh, this rental season, what can renters expect? Now, what I've been saying is they have a lot more choice, they have a lot more movement incentives, and they might be able to take a little bit more time, if possible, to search for a rental unit because they might be surprised on the amount of supply. But what does this mean for a renter side of things? Because typically the winter months, we don't see as much activity, but should there be a little bit more if you're able to move now?
Yeah, from the perspective of someone who's been pushing off a new move, absolutely. The next few months, and really likely the year following, will continue to show to offer greater and greater variability, versatility, variety, and that is all going to lend a lot of value to to you if you're looking to move somewhere. Honestly, on the purpose built side, there are more and more and more rental incentives than ever before. Uh, the most common ones are going to be 1 month free. From there, we see quite a few properties that are offering some additional rent incentives, maybe rent discounts. Past that, we also see occasionally 2 months off rent. Primarily, we're going to see that in some of the larger, a little bit more highly priced properties, right? Some of the more luxury oriented rental developments. Otherwise, we see that it's really kind of across the board. When you actually break down and you look at the trajectory of rents by property types, though, you're absolutely right. It's not really the apartments. Those are moderating, stabilizing. But on average, they're going to be anywhere from 8 to 15% more affordably priced than comparable condominiums, right? With condo owners, they don't have the same level of market knowledge, market awareness. They're not required to price so many, and so
Hmm.
the units are never going to be priced in identical or an identical relative fashion to the overall market, right? And so as a result of that, oftentimes you find that condo units are priced more more highly, right? When we actually when we wanted to look into this a little bit and try to understand how is this actually breaking out in the market, is this are we seeing this across the board? Are we seeing that there's a focus on one end of the market versus the other? Size, age. We see really, the story that has been kind of everywhere in the news, which is that the most expensive units are the ones seeing the greatest depreciation or the greatest repricing, downward pricing.
Hmm.
We see that the smallest units are also the ones where we're seeing more so relative repricing activity. And then in terms of age, it's really the new construction. It's the stuff that was priced right at the top of the market that is now coming down, and that's where we're seeing. So it's really this three-part effect. So newer properties with very small sizes, not necessarily as well laid out, as practical or convenient. That's where we're seeing the greatest compression in terms of prices. The rest of the market really isn't seeing as much price compression, and that's because again, we have to remember that when we quote this average rent, we're just talking about this is the average value of all the available units in a particular market. There is still variety there. That means that half the units are
Yes,
priced above and half the units are priced below,
but below.
right? And it's one end of the market that's really pushing the entire average down right now.
I think that is a good point because when I have conversations, it seems like people think that this is the cheapest cost of rent is in the city. And I'm like, that's not the case. This is the average, meaning a lot are lower than this, right? I think that's a really good point to stress. And the one subset of the market though that did see a larger annual decline was shared accommodations. Now,
Mm.
I have a theory why that's the case. Vancouver saw a 16% decrease. Calgary is getting close to a 10% decrease in shared accommodation listings. And before I say my theory why I think this is happening, do you want to maybe give your little expertise there about what's going on with shared accommodations?
Yeah, absolutely. So one of the big factors here is not necessarily just going to be the prices that are being achieved, but it's also in the um, the properties that are actually being listed. Okay. We're seeing that obviously a large number of the shared accommodations are going to have, are primarily going to be targeted at younger students.
Mhm.
Okay. They're going to be targeted at active students. They're looking at people that are looking actively at kind of saving a little bit of money. Their budget may be more constrained, and as a result of that, they're more flexible or more amenable to some of these more alternative living situations. Okay. When we look at the last few months, one of the reasons that this is happening is kind of twofold. It's on one end, we're seeing that at the top end of the market, some of the units that were more appealing actually got rented. Okay,
Mhm.
which is bringing the average down. But we're also seeing a gradual growth in these more affordably priced bedrooms in basements, in single family homes. There's a lot of variety. There's more and more variety. There's more and more listings right at the bottom end of that market, trying to really entice people. Right. We saw quite a few units. One bedroom in a shared house for between $500 and $700 across various markets, and and then in some markets, there's also the prevalence of just co-living. Co-living properties are bringing up certain markets because they're offering that higher standard of living. It's still more affordable than living in an entire unit, but because we're including them in the same category, that's actually causing the average rents to increase. Specifically in Ottawa, in a lot of the other markets, we're not really seeing that, and that's because primarily, again, we're seeing a lot of these more really affordably priced options coming in at the bottom of the market.
Yeah, and we did a story, excuse me, not too long ago about the drop in demand for off-campus housing and how that coincides with the drop in new study permits, the drop in new arrivals. So as you mentioned there, the drop in shared accommodation pricing, a lot of the renters who are looking for that are international students or students in general. And based on our data there, it did show that we are seeing quite a large decrease in demand, especially in that kilometer and a half radius around post-secondary schools. And I'm also curious, I think there's probably a little part of the market as well where rental prices have gone down enough in some areas where maybe somebody who was having a shared accommodation listing can now get themselves a studio or one bedroom apartment. I think that probably plays a little bit of factor as well. Um, but we did see a huge drop.
I'd spoken to a few landlords over the last few months, and they were telling me these landlords in particular were they had student housing units, right, or they had homes they primarily rented out to students, and they were telling me that it's become a lot harder to rent. In the
Mhm.
last year, a property wherein they would traditionally have rented all of the units out by maybe as early as April. At that point, they're well into the summer months, and they're still not rented out, and that's simply
Mhm.
because there are so fewer people uh, that there's just more variety, right? Um, Another reason for why we're seeing some of these kind of units right at the lower end of the market is because the people that used to rent these units, some of them in some cases may have left the country. Now they're available. They put them back up to rent, and now there's a hole, right? Because not as many people certainly may be interested in living in kind of those conditions, suffice it to say. And that's resulting in a lot of these units staying on market for longer right at the bottom end.
Mhm. No, it's a great point, and like looking to our student article there, just for a little more context there, we were looking at one bedroom rent changes with university areas versus the city averages. I think that was the big thing we wanted to see. How different is the off-campus housing kilometer and a half radius to the city? What we found was universities with really high international enrollment. That's McGill, which has about 30%, UBC, which is close to 30%, Dalhousie as well. We found that these areas experienced much greater rent decreases from 2024 to 2025 than the city average. McGill was about four times Montreal. UBC was well double what Vancouver was seeing. So that plays a factor in the shared
Yeah.
accommodations.
On the flip side, we had universities that did not rely as heavily on
Mhm.
international sources of international students, and now that
University of
we have
Calgary.
this decline, exactly, University of Calgary, University of Toronto as well,
Mhm.
um, and as a result of that, they didn't see that above and beyond decline in both rental demand and asking rents because there wasn't this hole in the market suddenly.
I'm trying to think what the shared accommodations listing market is going to look like in 2026 and 27. I would imagine it's going to continue the slower trajectory, but I wonder if there's like when that rebound happens, because like I said, 16% decrease in Vancouver. That's quite a lot. That's it, and it's hard to say what's going to happen because it does seem like through 2026, they're going to continue the lower amount of new study permits issued. So it does seem like this trajectory of slowing down the rental market through international students is probably going to be here to stay for the next year or so, which I would assume means shared accommodation listings are not going to all of a sudden get back to where they were.
Hmm. No, I think I have to agree with you on that. I can't necessarily say which one, whether it's going to go one way or the other. But what I can say is that we're not likely to see any substantial recovery. I mean, a lot of the properties that fall into the shared accommodation space, they're more informal, right?
Hmm.
These are properties that can be reconverted into, conventional housing, or be just put back in the market as a conventional apartment as well, right?
But again, quickly though, Dave, because I feel like we get down this path, and I get asked a lot. Shared accommodation listing is basically just a room for rent, right? That's how
Correct. Yeah.
we.
Regardless of whether it's in a condo, someone's looking to rent out another room in their condo, someone's looking to rent out a spare room in their house or basement, someone's looking for a roommate, or someone's looking to fill multiple rooms in their unit slash house. That's what we're looking at. It's just, instead of a whole apartment or a whole unit, it's just the room rental with some kind of shared space with other, or some kind of common shared space with other residents.
Okay, gotcha. Because sometimes there's a little bit of confusion exactly what that means. Because some people think a two-bedroom apartment is a shared accommodation because there's if two people rent it out, does that count as a listing? But in this case, of course, it does not.
Only if
So
someone already lives there and is looking for a roommate. Then that would be
gotcha.
considered. Yeah.
Dave, just quickly, we did mention the report there compared to the pre-COVID levels of October of 2019. Rents are still up on average in Canada by about 14%, or as we said, about $259 a month. What do you make of that? Is that do you see that as because we choose to have that included in our rent report because I think we want to make sure it's known that yes, rental prices are coming down. Just so you know, this is where it's gone just 5 years ago. So, do you think there's more room for this correction to come down, or do you think that it's hard to put the genie back in the bottle once we've seen these increases? Because to a lot of renters, extra $260 a month on average for rent from 5 years ago does seem like quite a lot.
Yeah, I mean, $260 a month across, an entire year, that's not insubstantial. That's over, $3,100 in total rent, or additional rent payments, I should say. If we're talking about what the direction that rents are going to go, whether they're going to continue trending upwards in the long run, you know, over the long run, yes, rents are going to continue to grow. It's a matter of life. If
Yeah.
inflation affects us all, unfortunately, right? Just like any other cost is going to go up, so will rental over time. Okay, or the cost to rent, I should say.
Mhm.
That being said, in the short to medium term, yeah, I think that rents are going to continue to decline. They're going to continue to drop. They're going to continue to moderate. And that's really a factor of, again, supply and demand. Supply continues to be very high. We're likely to see that supply drop off very quickly, very soon, once the buildings that are actively under construction come to market. Not as many properties. There are still quite strong construction starts because a lot of projects were um, in the planning for a long time. But certainly, once those projects are also brought to market, there are not going to be any new projects coming to market.
Mhm.
Lots. I've been hearing lots of stories. Some from friends, some from media about people in trades not having work lined up for next year. People having to shift away, look for new opportunities because on the new construction side, there's nothing going on. On the single family side, nothing. On the condo side, nothing. On the rental side, there's still some. But once that comes to market, there's going to be nothing left. And once that happens, then we're going to see a return to really tight markets, which is not going to, you know, it's not a positive indicator in the long run. It's not positive news. It's not good news for a lot of people, certainly not renters.
No, we don't want low
Uh,
vacancy rates. We don't want vacancy rates back to 1% again, right? That's
no, we don't want low vacancy rates because once we get to low vacancy rate territory, that's when we see rents run away. We
yeah.
see really unstable markets. We see price competition. People come in and they bid up a rental unit, and that's not the sign of a healthy market, right? Again, we want to return to sanity. We don't want to return to a highly competitive market where people are constantly trying to outdo and outbid each other to get it, to get their foot in the door, right?
Mhm.
Uh, So if we don't have a recovery, or if we don't have a return of this, of more construction in the long run, yes, we are going to have we were going to see that. Whether that happens in 2-3 years, I can't necessarily say. It's not going to happen next year. At least I don't believe it will. That being said, though, with the depressed rental demand that we're seeing actively, with fewer people entering the market, fewer people coming up and looking to move, that's also going to impact the market, and that's also going to further slow the trajectory of rents in the short to medium term. That's really it. It's a story of
Yeah.
fewer people looking and more supply coming, right?
Because in a healthy market, we want to see a couple percent increase of asking rents every year, right? We do want to see, like, we don't consider a healthy market zero or even a decrease, because a decrease means that property managers have no choice but to bring down prices because either they have overpriced it, there's too much supply, not enough demand. Like, a healthy market is a couple percent increase every year, correct?
Yeah, I mean, at the end of the day, a healthy market is one where we're constantly building so that there is constantly a supply of new rental units, so that people can move around in the market, right? A healthy market is not one where our 90% of a rental stock was built between 1956 and
Yeah.
1972. That's not healthy,
Yeah. No.
right?
Which is
We
where we were
need
at. That's where we were at.
that. Certainly in Ontario. Yeah, that's not
Yeah.
healthy. Like, in the long run, the only way for us to come back to from this hysteria is if we continue to build. Unfortunately, in the in the immediate present, that doesn't seem like it's going to happen, simply because the cost of construction, certainly a lot of the other ancillary costs, are so much higher now than the market rate can necessarily bear. Certainly, than a lot of renters are willing to bear, and that creates a challenge, right? So we need to find some other kind of synergy or stability in the market there, so that we can allow more construction to come to market. The government has obviously showed their willingness to promote new development. I'm not even talking
Definitely.
about the Build Canada housing. I'm talking about willingness to remove additional charges, willingness to defer, remove or defer GST. Um, a lot of these are things that are really good, but unfortunately, 5 years too late.
No, I think that's really well said. And yeah, it's one of those things. It's wait and see, right? It's only so much we can predict, but I think it's gonna be interesting, especially when the supply starts to slow down, how the market responds. But till then, I do want to plug our friends at the Globe and Mail for an article that we helped put together along with our friends at Urban Nation and our third-party licensors. What we did with the Globe and Mail was provide them a ton of data for their new exciting article where they ranked 235 Canadian cities, each with a population of 20,000 as the bare minimum. And what they wanted to see was the best Canadian cities to rent. Now, what they did was they used four metrics to put this together: affordability, which compares the average rent of average asking rents for obviously purpose-built rentals, condo rentals, to the median income of that city. They also use availability, which of course measures the available amount of rental units active per capita. They also looked at stability, which looks at how rental prices have fluctuated over the past 5 years. Then they had a livability score where they examined walkability, car friendliness, proximity to grocery stores and parks, stuff like that. And they put together this terrific piece that we were happy to help contribute our data for, called Canada's Most Renter Friendly Cities. What I want to talk about with this article was I've had a lot of conversations with reporters out west, because a lot of the top 10, 15 cities were out in Alberta. Edmonton was number one. We're seeing Grand Prairie number three, Spruce Grove, Red Deer, Airdrie, Calgary is number 12. So a lot of the top cities that we consider, or the Globe Mail considered, the best to rent were out west. I want to chat a little bit with you about that. Typically we know that a lot of these cities are six, seven, $800 less than the national average of rent. Um, but there's a little bit more that goes behind that. So I guess one, were you surprised to see so many of these cities out west rank so highly on this report? And I think two, do you think that signals a good future for Alberta rentals, or do you think that's something that other areas should look towards?
Well, let me answer the first question. No, I'm not necessarily surprised. At the end of the day, if we're looking at primarily the cost of living, we're looking at livability, and then at the end of the day, we're looking at the cost of renting relative to incomes.
Hmm.
out, Alberta certainly has kind of the perfect storm, or offers the perfect assortment there, because at the end of the day, again, more affordably priced. The cost of living is a little bit lower. Incomes, depending on where you are, certainly which industry you're in, can be stronger as well, and that makes them quite livable. We've been saying for a long time, if you're looking for a region with more affordable rents, look at the prairies, right? Obviously, there are a lot of other considerations. I can't just say, you can't afford to rent here, move to Saskatoon,
Right.
because you might not find the job that you're looking for out there. It might not be available. On top of that, there's also a lot to be said about having a, familial safety net, right? You can't.
Mhm.
It's hard. It's a lot harder to move away from where you have your friends and family, because that obviously it has a substantial value to people. But if we're looking at it kind of on an even playing field, yeah, these markets out west have a lot of value to offer.
Yeah, I wasn't surprised at all. When you look at rents that are like Edmonton, for example, it's about 700 less than the national average. One bedroom apartment is around $1,300 a month. There's a lot more choice. They're bringing a lot more supply. Alberta was a lot more quicker into bringing new supply. They obviously have the space to keep building the city outward. So when you put those factors together, I wasn't too surprised, but it was good to see. So I do encourage our listeners and readers to check that out. We will link it in our show notes for sure. A couple more things to plug in. I wear these hats every data dive. They are our friends and partners over at Raise the Roof. Their mission to end homelessness is something that we obviously are very much aligned with. So we will add links in order to buy hats, especially their 2 campaign, which I'm sure a lot of you already know about. So we love Raising the Roof. And finally, we have included a feedback form on the REM report. It just sits on the right hand side right next to the scroll bar. If any of you guys want to have your opinion heard about the REM report, what you guys like about it, what you don't, what we could do better, we're very open to hearing feedback, and we might be
We read
sending
all the
out these
comments.
we do read the comments. In addition to the pop up, we do have a longer form survey that it links to as well. If you have a couple more minutes of your time, because ultimately this report is for you guys, and we want to see it serve as many people as possible and improve as we go. So yeah, just check out for the feedback form. Check out Raising the Roof, and we will be back next month for the next data dive. David, appreciate you always, buddy.
Always a pleasure.